everybody. Back to another DeFi Raiders AMA. My name is Relentless. Today we're talking to Darren, the CEO and co-founder of IPOR Labs. I really appreciate you joining us today. Super excited to talk to you. Really excited to hear what you guys are doing as far as changing the credit landscape in DeFi. So if you want to go ahead and start off, give a little introduction and kind of your background and how you ended up founding IPOR.
Yeah, sure. So I guess a quick high-level introduction of IPOR is it's this, we call it the foundation of the DeFi credit markets. And why we call it that is it's this invisible layer that will sit underneath the DeFi credit markets to add this kind of stability and predictability. We use a couple of things that are prevalent in traditional finance. Actually, the protocol is called IPOR. It's a little hat tip to the LIBOR. It stands for Inter-Protocol Overblock Rate. And you can think of it as the risk-free rate in DeFi, or what is the cost of capital in DeFi. And so this is, it's a pretty big thing in traditional finance. And then, on top of that, we build an interest rate derivative, decentralized exchange, and other instruments that are in process. And so these things can be used to, for example, hedge your interest rate risk on a loan. And, let's say the output of that can be, someday down the road, you might get a mortgage that's quoted off of the IPOR. Some spread is added onto that. And you use some of these different interest rate derivatives on the background to hedge it to make sure that you have this predictable cost over time. So this is why we call it this kind of base layer of the DeFi credit markets. A little bit about my background. So I've actually building in DeFi. This makes it a dozen years for me, actually. Coming up on year 12. I started in 2011, and this was when the crypto space was very early. It was much smaller, and because it was much smaller, it was very different. You had a different landscape. I was running biz dev for one of the world's first exchanges at that time. And that was TradeHill. We were the number 2 to Mt. Gox. And you had a lot of people that looked at it, from a very kind of particular point of view, worldview, perspective, towards authority. But, now we have a lot of people in the world that are looking at it from the utilitarian perspective. And that's really where IPOR fits in. It's very non-degen DeFi. And it's really trying to get this base layer of the fixed income markets.
Okay, very cool, very cool. I appreciate that. Super excited to dive into a bunch of the different aspects of what you guys are building. You got a lot going on. And then also, do you want to kind of chat a little bit about the team and the rest of the experience that you guys have over there?
Yeah, for sure. So first of all, besides this, the team, this wouldn't be possible without the team. So we have, I would call it a very small but concentrated group of gigabrains. So I don't know if you played around with the platform, but anywhere from you're talking about the user interface to the background, there's experts across the board. So there's about 17 of us total right now. I think 12 or 13 are full-time, the rest are part-time. So if you think about, derivative instruments, it starts with the financial risk management. So we have a team of 3 quants that are working on this protocol. It's led by Mau Hernandez, our chief scientist. And I know now IPOR is getting some Brazilian following. Mau is a graduate, I think, of Universidade de São Paulo. So it's, I think, one of the top math and finance schools in Brazil. And this is really how we get the quant modeling to manage risk, to get these fair value pricing for the swaps. Of course, you can't build something on chain without the engineers. So we have this fabulous engineering team that actually is flipping over from, our top engineers have, 14, 15 years of building enterprise software. And so if you know enterprise software, it focuses on scalability, security. And so the test suites that these guys build, across the entire, from the smart contract layer to the data to the infrastructure, this is a huge focus on security, also code optimization. And so this is really obviously important. You can have an idea, but if you can't implement it, then it's a bit useless. Even on our smart contract team, we have a PhD in applied mathematics turned smart contract developer. So that talks a little bit about, let's say, the core engine, the people that are building the protocol. Myself and my co-founder, so I'm more of the jack of all trades. Dimitar is really focused on the derivatives instruments and specifically the tokenomics. So if you've paid attention recently, we've had a huge uptick in TVL. That's been a really successful story of the power token dynamics. So maybe we can talk about this in depth later, but power token is basically a new DeFi primitive that allows for this kind of modular governance. So for example, with your staked token, so IPOR, you stake it for power token, you can delegate that across the number of modules. So one of the modules right now is the liquidity mining module, and the specifics of that are actually driving some interesting adoption right now. And so that's kind of his brainchild. We just brought on board Konstantinos Soulous, who has 15 years in hedge funds. He's taking on the protocol, the protocol to protocol business development as well as institutional. And we are rounded out by Mr. IPOR Intern. So you guys may know of him. And if you don't, you should definitely follow IPOR Intern, the most gigabrain threader in DeFi, in my humble opinion. And so actually we have a lot of people that come to IPOR because they find the intern first. And so that gives you a little bit of a sneak peek of the talent kind of across the board. And while we're on this topic, the community is really getting going. So we have about 15, almost 16,000 in Discord. And some present here are our IPOrians. And so, over the last year and a half, these are people that have been spending time with the protocol, getting familiar with it. And the IPOrian is the top level. So it's self-organizing. IPOrians can vote other IPOrians, and these guys are really the keepers of the protocol. So if you can imagine this kind of DAO structure forming, IPOR Labs is the first contractor that's actually building the IPOR protocol. We hope in the future that there will be many. The IPOrians are forming something like a board that's kind of external. And that's providing some governance layers, and then we're looking at building out governance around the protocol, and that's really one of the other main work streams besides the instruments this year.
Yeah, very cool. Clearly you have a very high level team. I mean, I've been messing around on the app. You guys have a lot of really cool features on here that I like the hedge calculator for swaps, and just all these different features just to kind of see everything that's happening with the money and then what's being built into it. It's super clean, by the way. I love the UI. Very easy to understand. So, and then also, IPOR Intern. I've been following him for I don't know how long after Rec Diomedes tweeted about him, and you are accurate. One of my favorite threaders, one of the few threaders that I have notifications set for. The dude is incredibly smart. So you guys have a super talented team. 100%. So, all right, very cool. I appreciate the great breakdown and talking about all the different people that you have on your team and how you guys were able to make this possible. So you've already kind of given a little bit of high level overview on IPOR. So let's kind of launch into the problems with the current lenders and lending models, and then the issues facing the DeFi credit markets. So like, what issues did you guys see, when comparing like an Aave and Compound that you use to kind of build IPOR? And then how is this solving or what are the major current issues facing the DeFi credit markets, and how are you guys aiming to solve that?
Yeah, sure. So the first one is actually they're extremely useful. Right, it's permissionless. You can take this credit instantly. It's really fascinating. and it really attracts around half of the capital, half of the TVL. But it has some issues. Some issues are kind of at the core construction. One is capital efficiency, but capital efficiency or lack of capital efficiency isn't necessarily a bad thing if we're talking about security, right? So we consider the IPOR the risk-free rate in DeFi, and how do we gauge risk in DeFi? The best proxy that we have are the over-collateralized markets like Aave and Compound, where you have to post over the collateral that you want to borrow, right? And then, of course, the protocol can liquidate the collateral to make the lender whole, and that's really important. So, if you characterize risk as default risk, these are very good. If we look at kind of, let's say, mid to the end of last year, we saw a lot of players, like Clearpool, Goldfinch, Maple, Dam, all these guys really delving into under collateralized borrowing, and a lot of that was actually being done by market makers. And one of the problems is, a lot of those firms blew up, or the collateral went sour. One of my old contacts was saying, why would you lend to market makers? They don't have assets. They're service providers. So it's a bit, when you have this, let's call it the hard asset in crypto like ETH, you have something to you mitigate your counterparty risk, whereas you have this legal contract or this IOU with a market maker, but it has different risk profile. So those are things we actually go back and say this over collateralized lending market is good, if we're talking from a risk perspective. If we look at the way that the interest rate is actually calculated on those, I would say it's crude. It's a nice mechanism that has been used to bootstrap liquidity. And we would say that it's optimized for liquidity rather than for rates. So I consider it, a very 1.0 DeFi construction. And this is this bonding curve. When you're up at this percentage of utilization, this is the interest rate, right? And you have really cool I would maybe V1.5 or 2.0 interest rate models. I would consider something like Morpho. That what they do is they're trying to create this, this Pareto improvement where both sides win, where you essentially match along the mid rate between the borrow and the lending. So you at least get the underlying protocol rate, the Aave or Compound rate, and then the matching rate can create a better paradigm. And the nice thing is that aligns very well with the IPOR rate, which is basically a mid-market rate. But I would like to see more kind of evolution and iteration around the interest rate space. And so, for example, just last week, the IPOR protocol was subject to an attack. It was an economic attack, right? There was no smart contract risk, but what was happening was someone was manipulating the rates on the in-credit markets. And that caused the rate to spike, and the attacker had a long position, and they were essentially trying to manipulate the rates for gain. And so you can read through the blog post about that, but basically, had to step in and hit a circuit breaker because it was a manipulation attack. It was very clearly tied to a single account. But what the issue is that there's this really kind of hockey stick spike in the rates, where if you get to a certain utilization, the rates go wild. And this is one of the issues that we were trying to solve for at the very beginning, right? We started this at the end of DeFi summer, conceptualizing it, when you had these rates that, they were going from 3% to 30% in a single day. And with that kind of volatility, you were exposed to all sorts of risks as the borrower or the lender. So having this kind of derivatives layer based on the actual market activity allows you to kind of hedge your exposure. And if you want to manipulate the rate, there's some cost to do that. There's some cost for the attack. So, we had an interesting update over the weekend where Aave just pushed a new utilization parameter for USDT. So they moved this utilization, it's called a kink, right? This kink in their linear function from 90% to 80%. And what that really does is it lowers the capital required to manipulate the index, which also makes it more problematic for protocols like IPOR. But actually the parameter right now, the AMM is volatility. It's volatility optimized, so it just creates market conditions where it's very difficult to take a swap because the spreads are so high. But this interest rate model and market is something that is, I think, I would like to see a lot of innovation around.
Yeah. Sorry. I was trying to get my mic to unmute and it kept remuting. Yeah. Thanks for the kind of thorough explanation there. And then, yeah, one of the things that I like that you highlighted was kind of, the wild rates based off utilization, which makes it creates the volatility and it makes it really hard to kind of predict, right, what kind of returns you're actually looking at, which I know is something that you guys have worked on solving, is being able to actually have predictable rates. And that was one of the things that, well, when I first got into DeFi, right, I didn't really understand the point of depositing all my money and then not being able to use it all and borrowing against myself. And sometimes I'd have these negative interest rates and stuff like that. But I never really saw the point of any of that when I could just use all my money and make the plays and not have to worry about these crazy swings. And I like that you guys have kind of figured out a way. I know you're working on stuff for the future yield curve and all that, but have found a way to kind of set a predictable fixed rate. And so I'd like to hear it a little bit. We'll dive into a little bit more of that, but very cool that's a major focus of the problems that you guys are trying to solve, because that was one of the things that I just I never really felt like having to watch my health factor and stuff with these wild swings. So
yeah, I mean, we focus on fundamentals, and I'm quite risk averse, from a protocol side, right? And the IPOR protocol is risk averse by nature, right? It's going to these very, the credit, the interest rates on Aven Compound are fairly volatile, but they're less volatile than most of the other instruments, right? So, it's focusing on exactly this problem, and we can see, like, let's take a DeFi summer where you could get 10% on your stables, right? We see an inversion of that. So we see in this bear market that the interest rates on the DeFi protocols were hitting 1% and 2%. So with the major markets up at 4 or 5, you can actually have an interesting carry trade, playing these different rate dynamics, but the markets aren't efficient. There's not good, let's say, bridges for fixed income, and that's what leads to these kind of disparities. The other side is you also have a lot of degenerate, behavior that doesn't really care about the interest rates when they're looking to get 10, 20% per day on an asset. So the question is whether these players will dominate in the future. And seeing the blowups at the end of last year, maybe we get some more rational actors in this next run.
Yeah, I agree, and I think you can always make the case that degens are going to degen, but it kind of comes down to a point of how long will some of those things be able to be available. With those major degen type protocols, what's the real appetite for them? With the amount of money that people ended up losing, kind of at the end, where the kind of feeling that I get is that the majority of people are looking for these opportunities where they can make stable long-term returns, and be able to, borrow some money if they do want to do some of those degen things. But I think in reality, the general sentiment I get is that people are trying to build their bags to be kind of long-term focused, and then, getting into the trading aspect of things to be able to do their kind of degen side.
Yeah.
So, all right. Well, let's kind of launch into the different features of the project. And let's start with kind of breaking down the index, which is kind of the base for everything. So do you want to kind of to talk about the index and how that kind of operates and everything like that?
Yeah, sure. So the index is really based on a couple of TradFi principles, right? And we get a lot of funny memes because it's called IPOR, and people say IPOR or iRich, but the thing is, it's based on it's a hat tip to the LIBOR. And if you don't know what the LIBOR is or was or still kind of is, but is now being wound down, LIBOR stands for the London Interbank Offered Rate, right? And this was the risk-free rate that banks lend to one another. And it's useful because it's a benchmark that says this is the rate. If you want to get a credit product, you get it at the LIBOR plus some spread, right? LIBOR plus 2%, right, for a fixed rate, for example. And even if you don't know it, you have a benchmark rate that is underpinning if you take a car loan, if you take a home loan. So it's this kind of if you don't know how the construct works, you're still subject to it if you take any credit instrument. So the LIBOR was set by it's a survey of banks. You go to the London banks and you say, okay, so how much would it cost to borrow GBP, to borrow USD, euro, Japanese yen? How much would it cost to borrow today, tomorrow, 30 days, 60 days, 90 days, and so on, right? So it's really a very simple construction. You just ask some of the most liquid banks, and they give you the answer. You take that, you take the top weight, and you take the top value and you take the bottom value out, you throw them out, you volume weight the rest, and you print it once a day, 11 a.m. British Standard Time, right? It's a simple construct. It's not a very good internet times construct, right? It's a very old school construct where you have to phone a friend or you have to send a fax to get these reporting. And the issue with the LIBOR was actually Facebook. The bankers inside were using Facebook Messenger to write to one another to over or under report by a single basis point and take the opposite side of a trade. So the bankers were manipulating the rates for their own profit at the expense of retail. Why? Because it's going against the depositors, and they were pocketing, potentially a couple million per trade. Right, so you have human greed, you have self-reporting, and you have all these issues that were problematic with the LIBOR. But it's this benchmark rate is really a requirement to structure different credit products. So we look at crypto, we look at blockchain, we look at smart contracts, and we say these present a better paradigm for a benchmark rate across the board. So if we look at something like Aave, or we look at something like Compound, a smart contract reads other smart contracts. It reads the state, it reads the utilization rate, it reads where it is on the curve, and it can calculate transparently, what the current rate is. It can print that on chain. So instead of bankers phoning up bankers and printing it once a day, we can get this rate that's really block over block, which is as close as we can get to real time in blockchain. And so, for example, in the attack last week, that was, it's an attack, it's a manipulation, but it's also a valid market action. You had someone that was actually taking an on-chain activity to push the rate up, right? And this is also transparent. So you take the best of blockchain, you take the best of TradFi, and you marry them together. And that's really what we're looking to do at the IPOR protocol, which is take these constructs, which are, let's say, the fundamental parts of the credit market in traditional finance. We adapt them to DeFi. We take the best of both worlds. So we take this construct of a benchmark rate, and we build it inside of DeFi natively for DeFi. So we take some learnings from TradFi and build them into the IPOR index. And then for something like the interest rate swaps, we take the idea of this peer-to-pool model that's popularized by most of the DEXs, where you have a passive participant that is a depositor. You have this magic pricing engine, which is the AMM. And then you can create this kind of RFQ, or request for quote system, where it always is able to offer a swap. And so that's really kind of the key. We're not reinventing the wheel. We're adapting the wheel to essentially a new world.
Yeah, very cool. And I think that's a major point that you bring up about the transparency, right? From what happened with the British Bank, right? With the manipulation there, and people. That's the ultimate goal of decentralized finances, to have that transparency, and people to have control of their money. So I think that's important. That's one of the things that you guys are focusing on. Yeah, so very cool. So then, a couple questions just with the index. I know you guys are currently focused on just the USD stables, right? Do you guys have plans as this progresses to feature any other type of assets, volatile assets? And if so, what kind of benchmarks are you guys looking at meeting before you would kind of move towards those?
Yeah, sure. So maybe I can step back to the selection process of why there's an IPOR USDC, IPOR USDT, and an IPOR DAI rate, right?
Yeah, absolutely.
So this is market driven. So, at the time of construction, which was about 2 years ago, we were looking at what are the most liquid credit markets by, who is borrowing what. And they were USDC, USDT, and DAI. And so that was the basic selection process. At the time, most people don't borrow the crypto assets because they might as well buy them, or it also creates a risky dynamic where if the price appreciates, then also your obligation does. So it makes more sense to post the crypto as collateral, and then borrow stable against it because you don't have that price risk on the on the asset that you're borrowing. But coming up, I think one of the most interesting opportunities will be how this kind of ETH staking rate plays out. And a lot of people are calling it the new risk-free rate in DeFi. So we'll see, whether maybe everything goes to like these liquid stake derivatives, because it doesn't make sense to not have your Ethereum staked if you can get that staking yield, but also people want to play with it. People want leverage. They want to be able to use that as collateral to do other things. So this is the most interesting thing. The big question is, how do you build an index, if at all? And what will the behavior be? So this is a huge opportunity. It's also a big risk. You also have very divergent behavior in how the interest rate is calculated, or the staking rate is calculated across the different LSDs. So this is something that's very much under study.
Yeah, very cool, very cool. Yeah, I'm LSDs are obviously a hot topic and have been for a short time. So I'm super interested in how that kind of progresses. And then, like you mentioned with ETH, right, the capabilities of being able to earn yield from that and be able to use your ETH in a liquid version. So yeah, very cool to see how that progresses for sure. So all right, so you mentioned the swaps earlier, right? With your derivatives. I know this is what like a lot of people really want to talk about. So you kind of want to break down the swaps first. What is an interest rate swap for anyone in the audience who is unfamiliar with the concept, and then what you guys offer as far as that?
Yeah, sure. So a swap, it's in the interest rate perspective, you're taking a view, or you're taking protection against future interest rate movements. So, for example, if the interest rate goes up, you're a borrower, you increase your repayment obligations. If it goes down and you're a lender, it decreases your future income, right? So these might be natural swap counterparts. So both sides want to control their risk. They don't want to face the, let's say the negative outcomes of lost income or higher borrowed rate. And they might say, hey, let's just meet in the middle. Let's keep these rates set. So they might end up, going on opposite rates or opposite sides, where the borrower chooses to take a pay fixed and they receive the floating rate. So that way, in case the rate goes up, their derivative wins, so that they can pay that off, for the the extra borrowing cost. And on the other side, you'll take a play floating, receive fixed rate, as a lender, because you want to make sure that your future income isn't hurt by a rate drop. and of course, if it goes in your favor, then, that's also in tough luck. The reason that you're doing this is try to hedge from the negative events, right? So that's the basic function of a swap. In an interest rate swap, you're exchanging cash flows. So in the example I just gave, that's between two counterparties. And typically, in TradFi, you have it between financial institutions that are exchanging cash flows. In the IPOR world, you have someone who's actually trying to they're taking a view on their rate risk, and they're trading that with the liquidity pool. So the liquidity pool is essentially a passive underwriter, and then the AMM sets the pricing in the form of a spread. And so, you can come in. That means that at any time, this was kind of one of the innovations that we really liked about DeFi, is that the liquidity pool and the AMM, it can always offer an instrument. The pricing, is up to the taker or the trader to decide on. But it's this passive, kind of construct that means there's always a market available. And so this creates kind of an RFQ dynamic, or request for quote, where the trader can come in, they can get a quote, and they can choose to take it or not. And they have this kind of rolling instrument, at least in the current construction, where the instrument matures 4 weeks or 28 days after it's taken. And that means that, they can use it to match their basic credit market activity. So that's a little bit, about the first instrument, which is 28-day cancelable swap. Now we are undergoing some study, what the next instruments will be like, and so there's a good chance that that optionality goes bye-bye, because to be honest, it's really been only used kind of by attackers, by economic attackers. So maybe the real innovation around this is the rolling structure. You can take a swap at any time that matches your credit position.
Oh, that'd be interesting. Could you explain just a little bit what you mean by how's it been used by attackers?
Yeah, so if you can cancel it, this is some of the inspiration was the birth of the perpetual swap. This was invented by Arthur Hayes, BitMEX, because traders on BitMEX, they didn't understand that if a futures position it expires at some point, and they were calling foul play, and so they invented the perps because of actually the ignorance of the traders on the platform. But, like if you look at the DeFi credit market, we were actually looking at the actual usage and the actual behavior by people on Aave and Compound. And, it's liquid, right? You can deposit, you can withdraw, at any time, right? So there's no lock-in, there's no term structure. And actually, the flash loans are one block, right? So you have this very kind of crazy short-term debt structure that's possible, right? But we were trying to create something that really matches the flexibility of the current DeFi credit markets. But for example, in the case that you are you're on the economic attacker side, you could take a position on the receive fixed side, you can take a position on the pay fixed side. You can push the utilization parameter so that you can take the other position. You can flush the rate up, and you can cancel the other position, so that you face no economic consequence for that. And so this is really where we've seen it being used. And so this is why it probably will be cut from future instruments.
Man, it's crazy the things that the effort that people put into figuring out ways to game systems and attack systems. I would never. I mean, I'm not malicious, so I would never think of stuff like that. But it's crazy that the lengths people go to make money.
Yeah, well, I mean, you have to think maliciously. You have to think, adverse attack. You have to assume this is happening. And actually, one of the first docs that we wrote inside was, outlining, what were the attack vectors, and it's this, rate manipulation on the in credit markets. And in the time that we were looking at it actually, the markets were so much more liquid, it raised the cost of the attack and the feasibility. So when you have, a couple of billion in outstanding debt, it increases your cost and your feasibility. The number of players that can actually effectuate the attack, plus what's your relative cost. But now down with at our current state, there's a lot of it's more attractive and it requires less capital. So there was around 30-40 million that was used in last week's attack to try to basically keep both the AVE and the compound curves right around this. I keep forgetting the word, but the place where the hockey stick goes up, the kink in the interest rate curve. So this is an idea of like, what's the cost of the attack? What's the feasibility? It's like, what's the amount of capital to create this distance to the kink? So if like right now that there's 5 million outstanding between the 80% curve on USDT and AVE now, that makes this dynamic, it changes kind of the risk profile.
Yeah, that makes sense. So if you eliminate the 28 day and make it this kind of rolling, how does that then limit the attack vectors?
So, for example, let's imagine that you have to keep balance, right? So the attacker, they open some receive fixed positions, and then some pay fixed positions. So if you open the receive fixed and the pay fixed, you're draining, on one side you're paying, right? You're paying to the pool. On the other side, the pool is paying to you. So in that dynamic, if they can't close the other leg, or if they can't close the other leg, then they're actually paying. They're not just paying the the cost of the attack. They're paying the other leg. They're paying the spread. So it diminishes the attack surface and also the profitability. So I mean that's a simple reason right there.
Yeah, very cool. Appreciate the explanation there. From someone who's not building a project like this, right, and doesn't have to think about these things, it's very interesting to kind of learn the ins and outs of what you guys are facing.
Well, I mean, let me show you another thing, right? So this idea, we had this idea of a reference leg, which is like a trailing moving average also, and that came into play as a very good protection because we saw some people that actually became depositors. So what they did is they have big enough capital to flush the rate up over a couple blocks, right? So they take a huge outstanding loan, which flushes the utilization rate up, and they're seeing if this pay fixed, if they can flush the rate up, let's say the IPOR rate up to 45%, and take a receive fixed at 45%, and then just bleed the pool dry like that. And it turns out that they couldn't. Why? Because with the AMM incorporates this idea of a reference leg, and the reference leg was envisioned just for that. So, for example, when the rate goes like this whipsaw in one side or another, you're not able to capitalize on the peaks and the troughs on the trailing leg, and it's specifically to prevent against this attack. So we spend a lot of time, let's say, in the war room, looking at these different attack vectors. And so, we're looking at the last week's manipulation to see, how we can protect the portfolio risk much better, programmatically. So it opens up a lot of good discussion and brings it, this immediacy, and it ends up making the protocol much better in the long run.
Yeah, definitely, and it brings a lot of reassurance to people about the effort that the team is putting behind it. So, and not just, a lot of people, when they think security, they're like, okay, well, did you get an audit, right? And, an audit only goes so far. But when you guys are taking the real world situations that are currently happening and using those to kind of attack your own system to make sure that you can, prevent that kind of stuff. I think that's another level of security that's super awesome.
Yeah.
So, all right. Very cool. I appreciate the thorough explanation there. That was very, very interesting, honestly, to learn about. So let's kind of move on, and just, I know I don't want to take up too much of your time, as we get close to the hour. So let's kind of talk about the AMM, and then we'll kind of get into the tokenomics. Just a few questions on the tokenomics. So you want to kind of break down the AMM, as it's kind of like between the index, the swaps, and the AMM. Those are like the three major factors here.
Yeah. So the AMM is really, I think it's a quite cool DeFi primitive. We can't copy paste, right? So this is a thing. Interest rate behaves much differently. It oscillates between values, so it's very different from assets. Assets, in the X times Y equals K dynamic is pricing essentially volume for volume for price, right? That's your trade-off. But in interest rates, you're really pricing a lot of volatility, because you don't have this absolute behavior, between two assets. You have this rate behavior that goes up and down. So on the quant team, we took a couple different models that are prevalent in traditional finance, specifically for interest rates, modeled them out, ran them against back testing of this historical IPOR, and used a couple different models that are specific to the behavior that we see in DeFi, which is extremely volatile, which is pricing like emerging market interest rates. So we have a couple of different things in the quant basket that are already good at modeling these things. So we take whole white, which is the traditional interest rate model. We combine it with jump diffusion, which is really modeling out these huge spikes that go up, but they come down, they mean revert, they come back to the mean. And then this model called Longstaff-Schwartz, which is pricing for the optionality or the cancelability of the swaps. And so the really interesting thing is, trying to build something that is good enough at pricing risk. It's a good enough proxy to price risk, but the trade-off is that it's cheap enough to run on chain, right? You can do anything if you have the computational power on a centralized exchange, on an Excel spreadsheet. But when you build something that you set and let go on chain and that lives on its own, you have to have these trade-offs. Otherwise, we can build a super complex model that is ridiculously expensive to run on chain and no one will use it, right? So the really big trade-off and the really big, the innovation is getting a good enough proxy for risk that's cheap enough to run on chain. And so one of the things that we're looking at, if we strip out this optionality, is that we remove one of the constraints which actually adds spread and allow it to have a more of a fair market dynamic. So this could be some of the changes that you see coming up. But being able to turn a very complex set of different quant models into a very simple, piecewise linear function that runs very cheaply on chain, I think that's a pretty cool achievement. And that's where you see, if you go into the app and you see, here's the IPOR, your fixed rate if you choose to pay fixed, or your fixed rate if you choose to receive fixed is this. So it's all built on this very cool approximation of, based on the quant modeling. And then you'll see more features being added in, which are for the portfolio risk management.
Yeah, very cool. Yeah, that's one of the things that I liked when I was looking around on here was being able to see, like, this is my actual fixed rate, what I'm going to get. And I did kind of look on some of your documentation for the quant modeling, but then I realized that my math skill level is not that high, and so I stopped trying. But very, very in-depth and well thought out. And I definitely like it, what you guys are offering here. So, all right, so very cool. So let's talk a little bit about just the one question I really have about tokenomics, I'm not going to break down, what's going to the team and all that stuff. People can look at the docs for that. But I know you guys are super excited about Power IPOR. So I was hoping you could kind of break that down, the mechanics there and everything for that.
Yeah, so maybe I'll break it down really quickly, and I definitely think that if you want to follow up on the tokenomics, we have Demeter. It's his brainchild in here, so he could go hours and hours, and I think like the really big tokenomics nerds would love to have that conversation. But for time, basically tokenomics, the power token, it's an architecture. It's a modular architecture for tokens, right? So you can take the token, you can stake it, and you stake it into this modular construction. And so, for example, IPOR becomes Power IPOR. That Power IPOR can be delegated to one module. It can be delegated to multiple. So, for example, what you can do right now in liquidity mining is you can delegate it to one pool, or you can delegate it to multiple pools, depending on where you're providing liquidity. Now, one of those other modules could be governance, another module can be whatever you can think of, right? So that's part of the cool thing. So with this basic construction, Power Token is now open sourced, and you can copy it and you can create your own modules to meet to essentially meet the needs of the protocol. The current liquidity mining that's on IPOR right now is one module that was created specifically for IPOR. It was created by Demeter and designed by Wukash and Dr. Evil, who's the mathematician I was speaking about earlier. But basically, the premise is that it creates this fair market dynamic. So you can copy this, you can change it, you can modify the curve, you can use a completely different liquidity mining module, right, depending. But this particular focus is creating more of a fair market dynamic. So in the current construct, rather than something like Curve, where you're locked in for 4 years, in the current liquidity mining, you're locked in for 14 days. Right, so you can unstake your Power tokens. There's a 14-day cooldown, and then you can do whatever you want with them. If you want to immediately unstake, you take a 50% fee. Right, so that means that you always have some price risk in the IPOR token as it's locked up in the staking, and you choose to take that price risk depending on what you want to do. In the current case, it's about optimizing or maximizing your Power IPOR rewards. So if you're a liquidity provider in IPOR right now, you provide liquidity and you stake your LP tokens, you automatically get liquidity mining rewards in the form of Power IPOR or PW IPOR. If you want to optimize that, you're going to want to acquire some IPOR tokens and stake them. So the way that this log curve works is that at the beginning, it's very easy to optimize your boost. Right, and depending on the shape of the curve, in order the attainability of getting a high boost, it really changes with the shape of the curve. But the idea is that it's ratio based. So whether you're a whale, whether you're a minnow, whether you're a shark, whether you're whatever size fish you are, you still have the same attainability to attain the same ratio of Power IPOR and the liquidity that you provide. So that makes it more of a level playing field. And we actually see that a lot of these kind of small to mid-sized positions, like talk anywhere from 1,000 to 20, 50,000. These guys are the ones that are playing the most with the Power IPOR. So they're optimizing their returns on the liquidity mining, where you have multiple depositors that are providing, 500,000 per asset, and they're not playing at all. So how this would, work out over time is the small and mid players that are optimizing, they'll actually probably tend to get more IPOR, over time, and they'll be able to optimize the rewards, and basically the newcomers, they can get this boost fairly attainable depending on the shape of the curve. But it will really be more detrimental to the whales that don't optimize, in the long run. So it creates this kind of fair market dynamic where you encourage players to play different games. And the ones that are passive, at the beginning, if they want to play long term, it's in their best interest to just acquire a few IPOR tokens, because the gain that they will get on that, is huge. But if they acquire more and more, at some point that marginal boost, it trails off. So this is the point of the current construction of the Power IPOR liquidity mining.
Okay, very cool. Yeah, that's what I was going to ask, right? Eventually it becomes, the law of diminishing returns, right? There's only so much that boost can be increased in relation to that curve. Right?
You can boost into infinity, but that also means that you are exposing yourself to more price risk, right?
Yeah.
So this you play the game that you want to, right? And some people may choose to boost into infinity because they're bullish IPOR. Some people want to find this, this maximized effective boost, which is always changing, depending on the state of the market. There are some people that want to play the game at all, but the whole point of the curve is that the people that are not playing the game at all, they probably should, at least just in a little way, or they're going to miss out. And so that's the basic design. And how people play, that's up to them.
Okay, cool. Makes sense. Well designed. All right. Well, then I appreciate the breakdown for that, and kind of how it, without going into too deep of the mathematics, just making it kind of make sense for the average person, and how that's going to play out. So I appreciate that. So last couple questions that I have here are one, how's the trading competition going? I know that you guys just started that. What kind of interest are you seeing? How many users are kind of involved with that?
Yeah, actually, unfortunately, I don't have the answers, the actual number of traders right now, but we're about to finish up our first week. So tomorrow at 12 UTC, we'll start the next week, right? So each week there is 7,500 IPOR tokens that are up for grabs. And actually, when we conceived this, that was about half the market price. Right, so now it's ballooned. I think it's around $250,000 in trading prizes in IPOR that are up for grabs. It used to be less, but the market decided otherwise. So I mean, it's a huge kind of prize pool. So in this first week, there's maybe around 50 participants, and the way it's structured, it's kind of like think of like a payout in a poker tournament, right? You get paid between a certain number of places, and I think with the up to 50 participants, the top 20 get paid, right? So I think it was like 50 and 25, so it would be 75 tokens. It's a couple $100 for the top 20 places. So maybe this will encourage other people to play, kind of in the coming weeks, because it's not an insignificant prize. But the whole purpose of the trading competition, and the whole purpose, like if you're inside the Discord, you have different badges and things, it's about education, right? Because it's a really long-term kind of protocol. It's not easy to grasp. And we're trying to create more content to conceptualize on a much simpler level. But the whole purpose of this competition is actually to get people to understand, that leverage, for example, in an interest rate swap is more about capital efficiency than degeneracy. And then if you start to understand that, you will start to understand, how this protects, this interest rate risk for much longer dated instruments, right? So how you can turn this 28-day swap into a longer dated instrument that can one day underwrite a home loan. So everything is really based on creating an informed community. So, this is the point of the trading competition. This is the point of a lot of the educational materials, some of the quizzes inside of Discord. So, yeah.
Yeah, very cool, very cool. Yeah, I always tell myself that I'm going to join these trading competitions, and then I just don't have any time because if I spend any more time on the computer, my wife's going to stab me. So I'm always interested to just kind of hear how they go for everyone. But I probably will try to jump. I'm probably not going to be a top 20 winner, I'll tell you that, but I am definitely going to try to participate in the next one so that at least I can thoroughly understand the platform.
There is a Biggest Loser consolation prize as well.
Sweet, let's go.
Which is, I think it's 1,000 IPOR, which is like 6,700. So, yeah, I don't know if that's something to shoot for, but.
No, I mean, if this had happened last year in my first year in DeFi, I probably definitely would have won. But I managed to apply some of those lessons recently. So
this is good. This is good.
Yeah, I aim to not lose anymore. So, all right, very cool. So my last kind of question, right, is just a roadmap kind of question. Is really just any plans for what you guys are thinking about cross-chain. And the reason I ask, right, is I understand completely the rationale for being on ETH with the amount of just total liquidity that's there and the capital for credit, right? But as new people are onboarded and they're looking at lending and borrowing and all these different things, some of these people are going to look and say, no, those rates and fees aren't worth it. Even though your fees actually, only 10% or whatever, it really isn't bad, and your initial 25% kind of cost, or $25 cost, sorry, not 25%, misspoke there. Some people are going to say, those rates aren't worth the fees plus the gas costs associated with ETH. So are there kind of like, do you have like kind of an argument towards that, or are you guys also kind of thinking about the ability to go cross-chain as you grow?
Yeah, well, first of all, most interest rate derivatives are for very large positions, right? So they make sense for, taking $1 million loans plus. But if you're taking $1,000 position in Aave and Compound, it probably doesn't make sense, right? So that's the first one. And we think that, even though it's accessible, it'll be mostly institutions that are trading this, or it'll be kind of these interesting, different products, which will be multi-contract calls. From the gas perspective, this is something that when you're thinking about these, very large scale positions, you're less, the gas cost relative to the notional size is much less. But this is market driven, right? So the reason we started with Ethereum because it had the deepest credit markets. We look at it now, it still has the deepest credit markets by an order of magnitude. But as those as the credit markets get up and running and more liquid on the other side, then we'll see kind of the market-driven demand. But these will all be DAO decisions in the future. So this kind of staged decentralization. Right now, some people in the DAO are starting to draft out what are the criteria for the IPOR to go cross-chain. And this is quite good. And, as soon as these markets get up and liquid, it makes sense.
Yeah, 100%. And I think it's important the distinction there that this really is geared towards institutional size companies, right? As obviously, I know that one of the big factors of bridging the gap between TradFi and DeFi for institutional companies is the credit markets, right? There's the old saying that, super rich people borrowed their way to the top, right? And companies borrowed their way to being rich. And so being able to access that credit and that capital, I think it's just appreciate the clarity there, that understanding the distinction of who this is really aimed towards.
Yeah.
So, all right. Well, Darren, I really appreciate your time. That's kind of all the questions I had. I wanted to just kind of cover all the major stuff and the important stuff. And is there anything else that what I like to do is just kind of let you have the last word? Is there anything that you'd like to put out there or talk about at the end?
To be honest, I would really just say, join the community, join the Discord to get involved in discussions, follow the Twitter, because, we're very much, building this around education, right? It's very non-degen. It's focused on creating the stability layer, and you can build more interesting things on top of that, different speculation, whatnot. But, understanding how it works and understanding its importance in building actually a sustainable DeFi credit market. That's what we're trying to. We're trying to build this narrative so people understand, how they can use the instruments, how they can actually build on the IPOR index. And so that my call to action would be really, get in, dig in, and interact.
Yeah, very cool. All right. Well, I appreciate your time. Hopefully, by the end of this year, I'll have a bag big enough to make to be one of the size type players that is on here. So,
all right. Good luck.
I just need a total reversal from last year, which I'm feeling confident about. So,
some of the best things that we learned from these markets are don't blow up. Right. That's the easiest way to success.
Yeah, I agree. So I really appreciate your time, Darren. Thanks so much for coming on. Really big fan of your project. Been reading tons about you and obviously following IPOR Intern for a long time. So I'm really thankful that you gave me some of your time and came on here and talked with me. It really means a lot.
Yeah, thanks for having us.
Yeah, absolutely. All right, everyone. Thanks so much for joining. It's been a great conversation with Darren, the CEO, co-founder of IPOR Labs. Get involved in their community. Go check out what they're offering. If you're hearing this now on YouTube, do us a favor, hit that like.